This week, a fast-growing microcap company in a very exciting sector released its final results for the 12 months ended the 31st of December 2022, and it revealed its revenue increased by 228%, but the share price hardly moved. Is this an opportunity? Let's take a look. The company is XP Factory. XPF is ticker. Now, under that name, they have two brands. Escape Hunt is the original brand, escape rooms, and Boom Battle Bar is competitive socializing. What does that mean? Well, let's have a look. So in these bars, they have darts, they have axe throwing, they have shuffleboards, which I got to tell you, that shuffleboard's there. It's highly addictive. And of course, they have escape rooms. But let's look at some operational highlights from 2022. Successfully integrated Boom Battle Bar into XP Factory Group, opened 27 in 1 year, 27 sites by the end of 2022. That was the target. They hit that, and that's 11 owner operated and 16 franchise. So you can understand a lot of spend went into this, okay? But nevertheless, growth happened as well, and most of those bars were open towards the back end of 2022, so you're not going to get the revenue recognition yet. It's coming forward in this year, but nevertheless, like I said, growth is still impressive. Achieved 97% customer satisfaction ratings across both brands. So let's have a look at the financial highlights there. 22.8 million group revenue, up 228% versus the prior year, 7 million. 2.6 adjusted EBITDA pre-IFRS, and that's a loss last year in 2021, sorry, of 600,000. So they've gone from 600,000 to 2.6 million there. 1.3 group operating profit, again versus a loss of $500,000 the year before. This is whilst building, the brand by expanding Escape Hunt and Boom Battle Bar. 35% return on capital. That's very good across Escape Hunt, owner operated estate. 3.2 million of cash at the year end, and of course they spent a lot. But if you look at this, 4 million by 30th of April. So that means cash has gone up. They're now generating cash in this year, which is very so that's basically how they look on the charts. Growth, EBITDA. Looks good, but let's have a look at the spreadsheet. Let's break the figures down, shall we? So here we go. On this side, full year results, 12 months. This year is 6 months to the 30th of June, okay? So we can sort of compare the two. It's always worth looking back and forward to see what's improving, what's not. And you see straight away, there's a lot more red here. There's operating profits. So anyway, let's go through the stats. Market cap, 30 million. Enterprise value, 29. That means they have more cash than debt because it's lower. Net asset value is 21, so not far off the net asset value, really. Revenue, 22 million. At the half year, 8. And so you can see towards the H2, and even though they opened most of their sites in H2 and there were strikes going on, they still accelerated revenue massively. Now this year, they've got a free run at it, of course. Operating profit, 1.2, whereas a loss there, 2.3 for the half year. So you can see it turn it around massively in the second half. Cash, 3.1, debt, 1.4. Operating cash flow, 3.3, but free cash flow is minus because, of course, they've been investing in openings and building sites, all that stuff. So there's a lot of spend going on in 2022, but now they have those 27 Boom Battle Bars open. They have, I think, 23 escape hunts open and franchisees. So now, that investment's been made. But let's look at growth. I always look at growth, value, health, efficiency, momentum, and forecast from brokers, okay? So top line revenue growth, 227%, and that's operating profit growth, 344%. And if you look at half year, it's in the minus there. So in H2, they've really turned it round. And in fact, like I said, most of the sites weren't open until the second half. Net profit growth was minus 38 there, minus 40. They still aren't profitable at a post-tax level, but they will get there because, of course, a year of build, a year of spend, now that's all been invested. Now it's just basically taking cash off customers. Operating cash flow growth, 348%. Free cash flow, 73% growth there. And if you get a value, even this is improving from 1.9 to 1.3, price to book 1.4, and look at that, it was an EBITDA minus there, and now 4.5, that's all it is, the EBITDA, so that's cheap basically, and because this is a new company, that is a less mature measure of profitability, and so that's what you go on, and next year they fully expect to be sort of post-tax profitable, and then you could judge it on a PE, but right now, that is a good metric, and that is quite cheap. Health. So they did decrease in cash of 5 million. Like I said, it's a year of investment pretty much, but they have a net cash of 1.7. Debt to operating profit, literally, they can cover that within just over a year. Current ratio and quick ratio, okay, it's been a lot of spend this year, so a lot's gone through the balance sheet, but that would improve. And all these margins here, like, looking at the gross margin, that's excellent for this kind of business. 64%. That'll drop through, and these margins will improve this year in 2023. And as far as it's concerned, momentum, it's all looking good. Let's look at the chart. And in fact, this is back in, I invested in these back here in, I think, 2020. So there. You see the golden cross here, really went at gangbusters up from, 7 pence up to almost 50 pence. And then rolled over. You can see here, it's always nice when the moving average is going parallel upwards, okay? And then it starts breaking down, and it hasn't really touched the 50-day moving average until this place here. Then there's a bit of sideways movement here, breaks down, and then we get the 50 crossing the 125, and it's the price crossing the 125. And when that starts to happen, you think it's either going sideways or it's breaking down. But we now know that was the top of the bull market, pretty much. So a lot of stocks had this sort of price action, and all of a sudden we see a rollover. This is called a death cross, where the 50 crosses at 200 day, and we've come down all the way down to now. Went back down to 10 pence, 11 pence, and you see a higher low, break up above 125. It hasn't done that since back in April. And you can see that now another higher low here, another higher low, but it's having issues here, breaking this 21 pence level, and it's done it 1, 2, 3, 4, 5. That's the recent news. The news on the results took it 20, almost 24 pence. But you get some people in this market, of course, taking profit, but momentum's there. It's above, the share price is above the 200-day moving average. It's above the 125, it's above the 50, and these are starting to go in the right direction. It's only a matter of time, I believe, before they break this. Why is that? Because, like I said, 2022 was a year of growth, of development, and now the margins start getting better, cash generation starts getting better. And in fact, let's look at the forecast here. These are the forecasts from 22.8, let's make this a bit bigger, from 22.8 million forecast to 42 million. So that's 84% growth on top of that. And then the year after, another 24%, 52 million. And as you can see, the margins are getting better on the EBITDA from 16 to 19 to 20, and then on EBIT and also pre-tax, but even post-tax going from 4 to 10 pretty much. So what kind of returns we expect? So based on this type of growth, 84%, 24%, 20%, okay, EBITDA margins of 18, pre-tax profit of 8, and post-tax of 8, pretty much 9 and 8 there. And these multiples, 1 times sales, 10 times EBITDA, and 20 times post-tax for a fast-growing company in a very hot new sector. That's totally acceptable there. Then you look at these kind of returns. Target price right now, I'd say for 2023 should be 29 pence, that's 42% up. And then 2024, 57 pence, 176% up. And 2025, you're looking at 68 pence at 231 pence. The broker target, a 12-month target, is 35 pence, was above mine, that's 71% up. So maybe I'm underestimating this here, but it's quite impressive. So anyway, like I said, that is not investment advice. Please do your own research. But so far, I have invested in XP Factory for a while, so I may be biased. So like I said, please do your own research, and hope that helps on an informational basis only.